Hello everyone. In this session, we will discuss reading number 16 of CFL L1 Financial Reporting Standards. This reading is connected to the previous discussion, reading number 15 Financial Statements Analysis Introduction. And in that reading, we discussed about the management is responsible for preparation and presentation of the financial statement, and auditor should or is supposed to review those statements, right? So the statement is management is responsible for preparation and presentation of the financial statements. Now, this particular statement creates a unique problem. So first we will try to understand what is the requirement of financial reporting standards. The important word here is these standards, and then we will discuss it further. Again, you will see a lot of repetition in this particular section. So most of the things you already know. So we will try to understand only unique points. Now let's imagine a scenario. We have say three companies, company A, company B and company C. And all three companies have gross profit for this year, the financial year 21, 21, 22. Okay, 2021 and 2022. And the gross profit for A, B and C is 100 millions. And there is one more information. All three companies spent 100 million on capex. Capex is a capital expenditure, that is kind of a purchase or say purchase of plant and machineries. Okay, and all three companies spent 100 million on capex. Now the general rule is you cannot directly charge this particular expenditure, the capital expenditure, to P&L. Okay, so just take 100 million and charge it to P&L. This is not possible generally in normal scenario. So here I'm discussing everything from the normal scenario or the general scenario, and then there are the specific guidelines which we will discuss in the coming discussion. So right now let's first see the general rule. The general rule is you should charge this particular capital expenditure to P&L, that is treated as an expense, and it should be charged in a particular manner. So expense charged to P&L, profit and loss, or the income expenditure statement, P&L, is value of your capital expenditure divided by life of that particular capex or plant and machinery or building or anything. Okay, so whatever is your capital expenditure, it can be plant and machinery, it can be some equipments, it can be construction of road or offices, buildings and everything. It is included in the capex only. So here we will assume that this particular capex is for the plant and machinery for all three companies, and for all three companies the life of that particular plant and machinery is 10 years. So ideally these companies should be charging 10 million, that is 100 divided by 10 million every year for next 10 years to P&L. So this particular expenditure gets amortized. Okay, amortize is not the correct word here. So we will be charging depreciation. Okay, so in specific reading we will discuss the differentiation between the amortization and the depreciation. Right now we will just focus on the key point here. So the point is you should be, or these companies should be charging 10 million to the P&L. Now, in the absence of this particular standard, which I just wiped out or erased, say the company decides, this company A decides to charge complete 100 million to P&L. Company B decides to charge or decided to charge 50 million in P&L and 10 million to P&L by company C. And now see how the net profit looks like. So here we are ignoring all the other expenses and incomes which are considered after gross profit. So we are just assuming after gross profit there is only one particular expenditure, which is a depreciation. So for company A, net profit is 0. Company B, net profit is 50 million. My pen is not working properly, sorry for that. Okay, and then for company C it is 90 million. Okay, so this is how they treated it. Now as an analyst, if you look at this particular so we are just checking it individually. Okay, so company A's annual report, company B's annual report are financial statements, or C's financial statements. When we look at it, we might end up concluding that okay, company C performed really well because there is 90 million of net profit compared to company A where there is a net profit of 0. So one might choose company C for the investment because it is looking really good. That is 90 millions of profit. Now here The problem is because we assume that there is no standard, there is no guidance on how to treat the capital expenditure in in your financial statement, specifically income statement, income expenditure statement. This is the problem. Okay, so every company is treating according to their own like gut feeling, right? So for this reason, we have financial reporting standards which tells us how you should treat a particular type of transaction and how you should charge it to the balance sheet, how you should show it in the financial statement, that is a balance sheet or income expenditure statement, or in cash flow. So we have complete guidelines, and these guidelines is called as financial reporting standard. Standard because it is standard for everyone. Now there is room for flexibility. Okay, so the standards are not very rigid, so they will guide you to a certain extent, and then you have the judgment. And that's why we discussed in the reading number 15 that if management is have some space for the judgment, and they took that judgment in financial reporting, they should specifically mention it, that this was the judgment available for us, and we took this particular type of decision while treating any transaction and while showing it in the financial statements, right? So after we consider financial reporting standard, now every company should be charging 10 million only in P&L, and now we will get a better picture. Okay, so 90 million. So financial statements in a way makes things comparable, right? Now one more thing. So maybe like some of you got this particular confusion, or the question is a really good word instead of confusion. Now see, so if you are feeling like why company A wants to charge complete 100 million in the capital expenditure as an expenditure of the capex, and show net profit as 0, whereas company C is showing 90 million profit. Okay, so even if like you imagine there is no certain standard, so why these type of decisions might exist? So the reason is, there are two reasons. First is shareholders, and second is tax laws. Okay. Now, think from the perspective of company A. So company A knows that, okay, my shareholders are very sensible and they are not going to see any problem with this net profit 0 reporting. So what is the goal of this company A is to reduce their tax expenditure. Okay. So that's why this particular company charged 100 million in the expenditure and is showing net profit is equal to 0. And company B's goal is to generate shareholders value and show their shareholders, okay, we are doing really good. And for this reason, the company C, not B, the company C is showing 90 million profit. Okay, so this is the reason why all three companies are treating their capital expenditure in the absence of accounting standard or the reporting standard differently. There are different goals. Even with the reporting standards, companies use all these type of tactics to reduce taxes or to increase the shareholders value or to show net profit higher to make investment lucratives. So these all decisions are still there because they have some space for the judgment, and they will decide, the management will decide what treatment to choose based on their goal. If they want to reduce the taxes, then they might choose the different like rules or the different judgment and on estimates, and for say shareholders value, they might treat it differently. Now there is catch. See, we discussed there is certifying authority who certifies the professionals or the accountants, right, for the audit purpose and for accounting purposes as well. The same certifying body generally, so in India now it is separate, generally is also responsible for drafting of accounting standards or financial reporting standards, FRS. Let's say FRS. Now the thing is, the tax law department is governed by directly government, and then From the shareholder standpoint, like in USA, we have SEC, Securities Exchange Commission. In India, we have SEBI, right? So these two are different entities altogether. So there is one government, and then second is the government authority. So now these two entities have discretion to say, this government will say, for the tax law purposes, you have to follow financial reporting standards. So separately, they will provide a separate notification that you have to follow this. And in similar fashion, SEBI or SEC will say, okay, you have to follow the financial reporting standards for the accounting purpose. And based on net profit, the tax will be charged, and based on the net profit, shareholders' value will be decided. Now, this is the general understanding, but it is not necessary. Maybe tax law department will say, or the government will say, for taxation purpose, you have to opt financial reporting standards to this particular extent, say XYZ statement, so 90% same, but in 10% area, we want to give you the guidelines like how you will treat the expenses or the incomes in your financial statements. So firms will create two different financial statements, one for the tax purposes, which is according to the government, and second is for the shareholders purposes, which is according to the SEC and financial reporting standards combined. Okay, so there might be difference in tax profit versus the normal profit, the shareholders financial statement profit. Okay, so this is what we need to understand, that it is not compulsory, like it is not mandatory for every government to adopt the financial reporting standards, but they will recommend to an extent that, okay, go for the financial reporting standards, work according to the financial reporting standards, but we want certain flexibility. So definitely tax law department will always try to increase the profitability or the profit of organizations so they can charge more taxes. So they will act according to their own agenda. And then SEBI or SEC, so the regulators who are working for the shareholders, they will act according to their goals or the objectives. Agenda is not a very nice word here, so go for the objective, right? So this is the general understanding and how it differs, the financial reporting standard differs from like authority to authority. And there might be some third type of authority or fourth type of authority who might come up with their own type of regulations or the guidelines. And based on that, things will change. Okay, so you have to remember this particular part for your, say, interview purposes or like that. And here, this is again the basic discussion. Now the question is of what is financial reporting standards. So just to reiterate whatever we learned in this particular point. So financial reporting standards provides the guidelines for how the income and expenditure as well as the asset and liability positions should be treated in financial statements of the company. So these are the general, that's why I'm repeating this word, general guidelines. Okay, so it is, as financial reporting standards, it is not mandatory. Regulators will make it mandatory for their own purposes. So they might select some standards and leave some standards. This is possible. In India, this is happening currently. Now let's start with the first, the financial reporting standards introduction. So accounting standards basis. So first we have conceptual framework for the financial reporting standard. Now let's see what is conceptual framework. So these are financial reporting standards which are applicable for companies, right? Now imagine a scenario, there is no standard, there is no reporting standard available on this planet. And there is one particular entity or say government regulator or government authority who wants to work on the financial reporting standards and who wants to provide the guidance to all these companies that, okay, you should be treating all these things in a certain manner. So what do you think? Like they will simply take one particular paper and start drafting the financial reporting standards? No, that's not possible. That's very problematic. Okay. So first, these authorities will create a conceptual framework. And this is a qualitative framework. Okay. So in this framework, they will decide certain ground rules based on which these financial reporting standards will be drafted. So the conceptual framework is used by the authorities or certifying bodies who work on the financial reporting standards, and then they will use this particular conceptual framework, and they will try to fit their financial reporting standard in this conceptual framework. So they cannot provide any reporting standard who is not properly fitting in this particular conceptual framework, right? So I hope you understood the reason or logic behind the conceptual framework. So conceptual framework is not directly applicable for the companies. Conceptual framework is kind of a blueprint using which financial reporting standards are drafted, and then these financial reporting standards are mandated by the law, and then companies will follow financial reporting standards. So companies are only concerned with the financial reporting standards. Okay, and that's why we have just an overview discussion of the conceptual framework for the financial reporting standard. So IASB is the authority who created the conceptual framework for the financial reporting standard. So let's see the basics. So it provides a framework for the development of the accounting standards. The purpose of the framework is to lay down the ground rules or the principles using which the accounting standard can be formatted or formed. So financial reporting standards or the accounting standards. So accounting standards provide the standardization of accounting of financial transaction. It improves the comparability and consistency, we already discussed, of the recording of the transaction, and standards also allows discretion to the management to describe the economics of the firm properly. So whatever is unique, see, not every company is same. Every company have their unique problems. So there is space for all these companies to present their particular transaction of 1 or 2 transactions, or say even like 100 different transactions in certain manner. But again, if you are moving out of general recommendation from the financial standards, then you have to specifically mention it in the notes to accounts or notes to financial statements. So financial reporting standards is useful for valuation purpose. Financial reporting is useful for the valuation purpose and not solely designed for this purpose, meaning so the reports, financial statements are useful for the valuation purpose, but this is not the only goal. As we discussed, there are taxation laws which might look for these financial statements, and there are 100 different laws. Okay, so again, this is a very separate area, okay, which is for the CPAs and CAs to look for, and the accountant's job is there, okay, and not as an analyst. So as an analyst, you need to only understand like how things work in this particular domain. This is for the general information purpose. Now, accounting bodies, standard setting bodies. Standard setting meaning these bodies are the ones who set the primary standards. Primary standards, I will explain you why I'm saying primary standards. So this is not general word. Primary standard is not like, this is my own word which I'm using here. Don't use it anywhere. Okay, now see, the standard setting bodies are professional organizations of auditors and accountants that is which are designed to establish or create or draft the standard for financial reporting. However, these bodies cannot enforce the compliance of the financial reporting standards. Again, as we discussed already, the regulatory authorities enforce the compliances with the financial reporting standards. So following table provides 2 primary standard setting bodies and their comparisons. So first we will see here, and then I will also give you some other insight which is interesting, not given in your book, but important. So we have 2 primary bodies. One is the FASB and second is the IASB. FASB is Financial Accounting Standards Board, and which is US based, okay? And the second is the International Accounting Standards Board, which is applicable for out of USA, but this is UK based. Now, SEC is Security Exchange Commission, which is a regulatory authority who can mandate the applicability of the financial reporting standards. And in UK, we have Financial Conduct Authority who can mandate the application of these reporting standards designed by IASB or FASB. So IASB provides US GAAP. US GAAP is generally accepted accounting principles, which is applicable for the USA. And IASB provides IFRS and IAS. So the list of accounting standard provided by the IASB goes like, So IAS are the old standards, and then they changed in recent time. They changed the nomenclature or the abbreviation for the IAS, and they started calling it as IFRS. So if you look for the list of accounting standards or the financial reporting standards provided by the IASB, so you will find few are mentioned as IAS and others are mentioned as IFRS. So there is no problem. So IAS is just old nomenclature, and then IFRS are new nomenclature, but they didn't rename the previous ones. Okay, so say for till particular date, whatever they drafted, they called it as IAS. After a certain date, they started calling it as IFRS. So you don't have to confuse. And it stands for International Financial Reporting Standard and International Accounting Standard. Okay. Now see what happens. What happens for the others? FASB and IASB. So these two institutions will primarily draft financial reporting standards. Definitely US GAAP. Again, you have to know that US GAAP is for the FASB and the IASB will provide the IFRS. So obviously for the US, UK, Eurozone, things are pretty normal. Anyone can easily understand what is going on there. Now what happens, or how these FASB and IASB work for other countries? Say for example, India or any other country who is not directly connected with these bodies. So what happens? There are two concepts: adoption and convergence. This is not given in your book. I'm just convergence. Now, the adoption is, say a particular country, just say XYZ, feels that, okay, so whatever is drafted, the IFRS drafted, IAS and IFRS drafted by IASB are very suitable for our country, our organizations, like whatever companies we have in our country. So it is suitable. Okay. So this particular country, XYZ country, will directly adopt XYZ. Directly adopt IAS and IFRS. Okay. So directly adopting means taking it as it is and making it applicable for your own country. So their certifying body. So in similar fashion, in India, we have like ICAI, Institute of Chartered Accountants of India. So in similar fashion, there will be one particular body who will look after all the reporting standards and everything. And say this particular body says, okay, we are good with these like IFRS and IAS, very suitable for our country's system or the like how the companies operate in our country. So we are going to adopt it. So they will simply take these standards, they will adopt it, and regulatory authority of this particular country will say, okay, now these standards are mandatory, and then all the companies will apply those standards. So this is the adoption. When you directly take it, when the country directly takes it, adopts it and uses it. Now there is second part, convergence. The convergence is something different. So in convergence, what happens? The convergence is the example of India. In India, we converged IFRS and IAS for the India's purpose. So ICAI, now there are certain changes. Now we have separate standard setting body. So ICAI will decide, okay, so standards are good for us, but not every aspect of these standards is suitable for our organizations or our companies who are operating in India. So what we will do, we will converge IFRS and IAS for our purpose. So what they will do, so the core is same, core IFRS is same, then they will delete certain part of the IFRS and add certain part of IFRS or modify certain part of IFRS to make it suitable for the company who are operating in this particular region. So this is called converged IFRS. Okay. So convergence and adoption, very simple. So, okay. So remember, India converges all the IFRS and IS, and XYZ, we took the example who adopted IFRS. Okay. And one more thing, like the IS, US GAAP and IFRS now try to compete with each other. So on many fronts, you will find similar treatment of transaction, but definitely there are certain differences, or there are many differences. But again, there is competition like this. Okay. Now see, IOSCO is the International Organization of Securities Exchange Commission, is not a regulatory body by itself. This is a key point you need to remember for the exam purpose. But the members of IOSCO are the regulatory bodies, like all the ICAI, all the regulatory bodies of particular country are the member of IOSCO, who is kind of a ICAI, I said it by mistake, okay. So all these regulatory authorities or regulatory bodies will become member. They will create a consortium. So they created a consortium called the IOSCO, and then IOSCO works for the single goal and will try to regulate everything. So IOSCO don't have any direct authority on any country. So they will recommend it to their members, and members have direct authority, right? So they will make mandatory for all these countries. Okay, so what to adopt, what not to adopt, how to treat transactions and everything, or how to regulate their exchanges. It includes, like, there are a lot of different things. Then there is one more thing, like Sarbanes-Oxley's Act 2002. So Sarbanes-Oxley Act is mainly designed to create, we have further discussion on the Sarbanes-Oxley. So Sarbanes-Oxley's Act is designed to improve the internal control in particular company, create the independence of external auditors, and there are multiple purposes, but main goal was to improve the financial reporting of any organization and make it more reliable for the shareholders or the other stakeholders. So Sarbanes-Oxley separates or tries to create more independence for the external auditor. External auditor as in statutory auditors who are mandated by the government to audit the companies, and they are the ones who say, like, okay, everything is fair, true and fair. Okay. So what, how they treated it. So they said, like, external auditor should not provide any other service. This is applicable in India as well. Any other service apart from providing this particular audit service for a particular purpose, that is statutory audit. Okay. So meaning the particular auditor cannot say work on internal control system or internal control manual of particular organization and simultaneously also work on their audit. Okay, so it is not possible. So you cannot, if you are the auditor, you cannot audit as well as perform other services for the particular company. So it should be separated. This is to create independence. Okay, and there are other further, like, guidelines. Lot of guidelines are there. So rest of the things you can read, and this is applicable. Sarbanes-Oxley is for this USA, and you have similar guidelines. Okay. Fine. Now next is the filing requirement by SEC. So here again, this is a repeated discussion. Here we have to just see like what are the filing requirements by the SEC and what type of forms are there. You need to remember for the exam purpose. So form S1 is the registration statement filed prior to sale of new securities to public. So whenever company is coming up with the new issue, so form S1 should be filed, which provides a lot of details like the company's performance and why they're coming up with the issue, what is the utilization of the funds, and there are 100 different things. But this is the purpose of form S1. So you need to remember what is the purpose only. Okay, registration statement filed by companies prior to sale of new securities. Then form 10K, you already know, it is for the annual reporting. Form 10Q, it is for the quarterly reporting applicable for the US companies, and semi-annual reporting applicable for non-US companies. Okay, but form is different. It is 6K. Okay, for non-US companies, it is 6K. And for US companies, it's 10Q. So 10Q is quarterly reporting for US companies, not necessarily audited. And 6K is the semi-annual reporting applicable for non-US companies. Then we have DEF 14A, is the proxy statement for the shareholders prior to annual meeting. and other. So wherever shareholders are required to vote, so proxy statement is filed either like on behalf of shareholders, or it is by the company, or behalf of the shareholders, or by the shareholders, depending on the scenario. So form DAF 14A is applicable there, again applicable for the USA. Form 8K is to disclose material events like acquisition, disposal, change in management, CEO left, new CEO came over, like this, and the corporate governance changes. Then form 144 is to notify SEC regarding the securities issued to qualified buyers. Remember, so previous was new issue, then this is for the qualified buyers, that is an institutional placement. Okay, securities provided to the institutions. And this is for without registering with the SEC. So these are not publicly traded securities. Then form 3, 4 and 5 is for the beneficial ownership of these securities by company's executive and directors. Okay. So this is a basic, you need to remember it. Then framework. So IASB's framework provides the qualitative characteristics of the financial statements and required for reporting elements. As we discussed, like you are going to see a lot of repetition here. So repetition starts. So first is the relevance. If the information in the financial statement influences users' economic decision, then it may be considered as relevant. So first qualitative characteristic is, first you need to see, like there are two primary characteristics a financial statement should have: the relevance and the faithful representation. These are kind of objective also of the financial reporting standards. So it should lead to relevance and it should lead to faithful representation. Faithful representation is for complete neutral. Complete as in complete information should be provided. Neutral as in you should not have any biases. Like I want to show more value for the shareholders. So this is bias. I want to reduce my taxability. Again, this is bias. So you have to be neutral and free from the error. In relevance, we have the information should have predictive value. So what is meaning of relevance? So information should have predictive value and confirmatory value. So materiality is the part of relevance of financial statement. Okay, materiality as in, again, we will discuss materiality later, but it should be material. So users' decision making should be dependent on that particular figure presented in the financial statement or the fact presented in the financial statement. So that's a materiality. So for characteristics which enhances relevance, comparability. Okay, so it should be comparable among the firms and in the time frame. So if you have say financial statements comparable values of 2020, 2020 and 2022, so you should be able to compare all three values, right? So net profit of all 3 years. So if company keeps changing accounting standard every year, the financial reporting standards treatment every year, so then automatically it will affect the comparability part. Verifiability. So under a certain setting, if you apply same methodology, if someone else applies same methodology, you should be able to get the same results. That's a verifiability. Timeliness. So reporting should be provided in a timely manner. It has nothing to do with the date of reporting, date of financial statements. Reporting has to do with, say this year, say this company ABC Incorporation's major plant caught fire. Okay, so the whole plant was destroyed, and this company decides, okay, so we will not report this particular event in this financial year. We will report it in the next financial year. So that's not timeliness. So the company should provide everything in timely manner. So if a particular event relates to this particular financial year, it should be reported in the financial year. So it is it is in the proper time. And then we have understandability. Understandability is a person with a basic knowledge of accounting should be able to understand the statements. This also includes the useful information should not be omitted even if it is complicated. So say as a management, I decided to say, no, okay, this particular forex treatment or say deferred tax liability or deferred tax asset is very complicated for the user's understanding, and I want to improve the user's understanding. So we will not show it in the balance sheet or the financial statements. So that's a problematic, right? So you should not omit any information just because it is complicated. So try to improve it, give some notes on it, right? So measurement basis as in whenever you have transactions, how to measure those transactions? This is mainly relates to your properties like plant and machinery, real estate, all the assets. Okay, and even in asset, the specifically we are mainly talking about the tangible assets. Okay, tangible asset like land, building, plant and machineries, equipments like this. So there are, let me count, 6 bases. So first is the historical cost. So whenever you are showing a particular item in financial statement, say you have plant and machinery worth 100 million, which you purchased 5 years back at 200 millions, and let's keep it as 200 millions only for now, ignore this 100 million part. So we purchased this particular plant and machinery 5 years back for 200 millions. So if you opt for the historical cost approach, then we will show this plant and machinery in our financial statement as 200 million, and then we will adjust all the expenses. Okay, so definitely you have to adjust the amortization and depreciation. Second is the amortization cost or the amortized cost. So second measurement basis is how you should, again we are discussing how you should present this particular plant and machinery in your balance sheet. What should be the value shown in the financial statement for this particular asset? So second is the amortized cost. So you take the purchase cost, adjust the depreciation. Depreciation again we will discuss later. Right now we already discussed what is depreciation. So adjust it for the depreciation. So you purchased it for 200 millions. Total depreciation in past 5 years is worth 40 million. So we will show it as 160 million in our financial statements. This is amortized cost. Okay. Then next is the current cost. If you decide to replace this machinery today, so what is the replacement cost? Okay. So again, replacement cost is maybe the same machinery is costing for 180 million. So should you show it as a 180 million? So this is a question, like what methodology should be opted? So these were the options available, and then we will, in next reading, we will discuss what option was finalized out of this. Current cost is the replacement cost. Okay. So 160 million is 180 million is the replacement cost. If you decide to replace machinery today, so 180 million will cost. So should you show it as 180 million cost? Because if you just see, this is the actual cost of machinery today, right? So 180 million, the value of machinery. Then next is the net realizable value. So if you decide to sell this particular machinery, then how much amount you will get? So say only 50 million. So should you show it as 50 million? Then present value. So just calculate the future economic benefits this particular machinery is going to offer you. Calculate the present value, and we can say, okay, this is the present value, and we can show it as the present value. So again, this is the option available. So this is the present value. And then last is the fair value, and fair value we can only discuss it. It is very scenario specific, like what is the condition. And in my opinion, the fair value is the biggest fraud of accounting system. Okay. So because there is a lot of flexibility, and there are things which you will understand afterwards when we will see your actual transactions getting recorded on the fair value. So these are the measurement biases or the measurement basis. Like on these basis, there are options to measure, but these all options are not open. We will see like what options are open and what type of measurement basis we can take for the measurement of plant and machinery. It is very country specific as well, and the reporting standard specific as well. Okay. Next is the assumptions. So in assumptions, we have constraints of framework, and then there are two important assumptions of framework. So constraints. So benefits, the framework should benefit the users just a second. So the user's gain from the information presented in the statement should be greater than cost of presenting it. Okay, so this is the again first constraints mentioned in the framework, and again it is not a framework like constraint, so it is provided in the framework, like, okay, so you have to ensure this. Okay, don't make things so complicated that the user need to spend or hire separate auditor to audit the financial statement so that he can analyze it. Okay, so that's the ultimate logic here. Okay, so don't make, so users gain from the information should not be greater than the cost of presenting it. And then the treatment of non-quantifiable information is not mentioned in the framework, and that's the problem of framework. Okay, example, we discussed like contingent liability, contingent asset in the previous discussion, like the off balance sheet items, the items which cannot be recorded in the balance sheet. So framework does not provide any guidance or specific guidance relating to those transactions. Okay, maybe like we can also say there are some situations like the corporate governance of a company. Okay, and it also affects the company's values and all everything. So again, we can also use this particular example to say like what is non-quantifiable information which is not mentioned in the framework. So this is better example, I think. Okay, so non-quantifiable information like the structure of the organization. There are a lot of different things which cannot be directly mentioned in the balance sheet. Again, so framework fails to address these issues. So two important assumptions of the framework. So these assumptions are used in the framework. So first is the accrual principle. Second is the going concern principle. So what is accrual principle? So accrual principle says record the transaction as and when it occurred. Now you sold goods worth 10 million and you will receive its payment next year. So should you record sale next year or this year only? So this year only. Why? Because sale happened this year only. So second example, you will sell these 10 million worth goods next year. You received advance payment this year. 10 million advance received. So should you record this transaction this year? This year, as in, should you record sale this year or next year? Next year. Why? The sale has not happened yet. So the rule is accrual. Accrual says record transaction when it occurs and not when the payment is finalized. So I took the example of sale. You can take the example of purchase as well. So same is applicable for purchase. So again, this is the accrual principle. And second assumption is the going concern assumption. So going concern assumption is that the firm will continue to exist for foreseeable future. So as we discussed in the previous session as well, what is the meaning of foreseeable future? So foreseeable future is not like say next 5 years, 10 years, 20 years. This is not the meaning of the foreseeable future. Foreseeable future means standing today, we don't have any indicators which shows that company will cease to exist or company won't be able to operate in coming few days, few months or whatever time. Okay. So today we don't have any indicator. This means the going concern assumption exists and company will exist for or will continue to operate for foreseeable future like this. So this is the meaning of, so word is foreseeable future, but the implication or the way we establish this assumption is reverse, in a reverse order. So we have to look for today's indicator. We are not planning for the future because again there is problem. We don't even know what is going to happen tomorrow. So how can you guarantee about the future, right? So again, the assumption is standing today, not tomorrow. And we don't know what's going to happen tomorrow. So general requirement for financial statements under IFRS. So IAS 1 defines which financial statements are required and how it must be presented. So these are the statements which are governed by the IFRS. So balance sheet, income statement, cash flow statement, statement of changes in owner's equity, and explanatory notes including summary of accounting principles. Again, we already know this. Features for preparing financial statement. So it should be fair presentation, going concern basis. Going concern basis is utilized. I'll give you example of going concern basis. Why it is important. Again, we will take the example of you purchase plant and machinery worth $100 million here today in this financial year or fiscal year, and we are going to amortize or depreciate this particular machinery over 10 years because life of the machinery is 10 years. Now, if the going concern assumption is already violated, so meaning company won't be able to survive for next year. So what is the logic of charging depreciation for next 10 years? No matter, like, the machinery will exist definitely, but your company will not exist to absorb that depreciation, right? So that's why the going concern assumption is important. So because of this particular principle, we are allowed to charge depreciation for next 10 years. Got it? Accrual basis already discussed. Consistency between the time periods. If you are reporting for, say, like 5 years, 10 years, 3 years, so there should be consistency in reporting periods. Okay, so you have to use the estimates and the treatments of the accounting standards in similar manner for year on year. So it becomes consistent. Materiality. So it is free from the misstatement or omission that could influence the user's decision. So again, materiality is assumption like this, but again, materiality also addresses that you should not omit or make a misstatement in any material transaction which might influence the user's decision. So if you, like, say there is a $5 problem in $1 billion company, then that's not the problem. The problem is there is $5 million problem in $10 million company. Okay. Then aggregation. So similar items should be clubbed and dissimilar items should be presented separately. Similar items should be clubbed as in, so if you have, say, operating expenses, so operating expenses should be clubbed. Remember, we used cost of goods sold. So cost of goods sold, there are different expenses, 100 different expenses. So we clubbed all those and presented as a cost of goods sold. So it should be clubbed. And dissimilar item as in, so two, like the selling expenses and factory expenses are two different expenses. We should separate it, right? So this is how you should present it. Okay. So this is all about the financial reporting standards reading. See you in the next reading. Thank you for watching.